Hey, greetings, traders. Thank you so much for joining our Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaducTrading.com, joined by Craig Shapiro, our MacroAdvisor EDGE manager. And we're going to kick this off with a little macro overview, what's on Craig's mind, most importantly, and then obviously take questions as it relates to macro, could be all the way down to micro. What are you asking on sector rotation or stuff that you're looking at in particular, and the dollar and yields and all that. So basically, Craig, why don't you kind of catch us up now that we're through debt ceiling drama? And I know that you are in micro focused mode on TGA and the rest as it relates to liquidity in the market. And I'm looking very much at market structure and how markets continue to grind higher, sideways to higher, despite lots of potential negatives. So give us a catch up on the macro, please.
Yeah, well, thankfully I can turn off the notifications for various DC insider Twitter reporters who are commenting on the debt ceiling, because that was 3 weeks of my life that I think I'd like back for sure. And look, I think not surprisingly they came to an agreement to extend the debt ceiling through basically the end of 24 into early part of 25, and with emergency measures, it's probably could run all the way through 2025. So this is unlikely to be something that we have to deal with for a long time, which is great. There will still be issues about funding various programs and whether or not the government is funded at the end of September, and is there a government shutdown, all sorts of things. But as far as market moving implications of what DC has to do on a macro level, I think there's really not much. It's basically stalemate in DC, no tax increases, no big spending increases versus what we already know. And, there'll certainly be some micro things on which bills, get passed, from EV to, inflation stuff, various other things, but that's not going to move the needle neither here nor there. So the big thing which we had been talking about was that there was a kind of two-phase process here where we had to deal with the debt ceiling and the potential for default and hedging around that. That was phase one, and thankfully that's over. But phase two, which I kind of felt was the more important phase, which would be this eventual refilling of the Treasury general account and the amount of Treasury selling that needs to get done in order to fund the government for the rest of this year and next year, and so that Treasury can have an ample amount of cash to operate with. And so and it's that act of selling a lot of Treasury bills and a lot of bonds and a lot of duration over the course of the next call it 7 months of the year, that is likely to lead to a fairly sizable liquidity drain, and that's going to have various implications for financial markets. And you can argue that part of the reason that we've seen such a strong equity market year to date has been sizable liquidity additions since the beginning of the year. I was checking earlier from the end of 2022, which maybe not is a tough place to start because the last day of the year that there's often a lot of window dressing, and so a lot of liquidity gets pulled out. But from the last day of the year, based on my metric, there's been $675 billion of liquidity additions into financial markets through yesterday. So that's not that just in the U.S. So clearly coming into the year, that's not something I would have thought was going to happen. I don't think that's something that the Fed thought was going to happen as they've kind of continued to do their QT. But the combination of a sizable Treasury general account drawdown and lack of Treasury selling has meant a massive amount of liquidity coming into the system. So now we're on the other side of that, which I think has various implications. I've been writing about that over the course of the last couple of weeks, and do think that is important as we head into the next 3 weeks of June with the Fed meeting next week and quarter end dynamics. So happy to really kind of drill down into that as needed. But look, this week is a fairly quiet macro week. There's no Fed. There's no Fed speak. There's the Bank of Canada is tomorrow. Australia was last night. There was some, but as far as macro is concerned, it's pretty quiet, which has meant lower vol and higher risk assets, and that's how we started the week, and we'll see how that continues as it is offset by this treasury selling, which really starts to accelerate starting tomorrow and Thursday, and then next week with a fair bit of duration selling. So I'm happy to go into wherever you'd like to go once you get your camera working.
I don't understand. I just had a 2-hour meeting before this. Is it overheating? What the heck is going on? Because I'm sitting here and then it goes away. I turn it back on. I got it. That's third time is the charm. It's not coming back on. So anyway, okay. So I'm getting advice on this. I've not had this happen before. All right. So what's your timing? I know you have, by the way, mentioned 675 billion. Matt King has it at 1.5 trillion since September, October bottom.
Right. Yeah.
Regardless, there's been a lot. And now the estimates are this pull out of liquidity between now and September end of year is going to be basically the same amount in kind. Do you have any timing on that? Because there's also lots of debate about this really being a negative for the market. So we got through debt ceiling resolution, that was expected, but this liquidity, we really don't know, right? So I know you have your
look, I think
this.
what
You're not alone.
I mean, here's what you know how much treasury is going to sell between, let's say, now and the end of the third quarter, because Treasury's already basically announced what they're going to sell. They get in their Treasury Borrowing Advisory Committee report, the TBAC report, which they put out a month or so ago, and they'll give an update on that in the end of July. They give you a schedule for how much what they're going to be selling as far as bonds are concerned, and how much cash they expect to have on the at the Treasury's account at the end of the quarter. And they did that for the second quarter and then that for the third quarter. So we already know this. And so the question with respect to the second quarter borrowings, Yellen has said that she would like the Treasury's account to be up at $550 billion. As of Friday's close, it was at 23 billion. We added 50 billion yesterday, or 48 billion yesterday. So we're up to 71 billion now. So already there's, a bit of a jump there. So maybe she doesn't get to 550, but she'll likely get to at least 600 by September 30. So what we know is that between the Treasury duration selling that happens on the 15th and 30th of June, there's 175 billion of new net supply. I'm sorry, 125 billion of new net supply that's coming. That we already know. We also know that there's a corporate tax payment that's going to go from reserves into the TGA. That's likely to be 50 to 75 billion. So call it 200 billion or so right there. That doesn't come out of the RRP. That is money that is coming out of reserves, because money from that is in the RRP is not going into duration. Money that's in the RRP now is earning 5.05%, potentially going up to 5.3%. Next week, if the Fed raises rates, we could talk about that in a little bit too. So that money's not going out of the RRP into the TGA. So at least 200 billion of liquidity being drained from reserves between now and the end of the quarter. We also have some QT, which will further reduce the size of the balance sheet. And then the big question is, how do you get from, call it 250 to 450 or 550, depending on where you see the end of the quarter, and that's through T-bills. And so that's where there could be money that moves from the RRP into the Treasury's general accounts, basically taking money out of the RRP and buying into these T-bill auctions, which are now all growing in size. Today, Treasury announced the 4-week bill is going to be up by 25 billion, I think, and the 8-week bill by 15 billion. 17-week bill up by 2 billion. So in every week, they're going to keep raising the sizes of these. So we're likely to have an additional 200 billion or so, 300 billion or so of supply over the course of the next 3 weeks. And so the question is, does all of that money come out of the RRP, in which case it's liquidity neutral, or does some of that money stay in the RRP, in which case in order to buy those T-bills, it needs to come out of reserves? And so for me, when reserves fall, that is the risk off potential. That is the liquidity draining situation. And so if the money doesn't come out of the RRP and it comes out of reserves instead, that's your liquidity drain, that's your risk off, that's your concern point. So yes, there's been various people who've said this is well known, well articulated, markets are front running it, but the supply hasn't hit yet. It literally is coming. So yes, you can know how big it's going to be, but you still have to purchase, and there you are. And it still has to be done. So look, again, this is kind of minutia. There's been a lot of newly found TGA, RRP experts all over the market and Bloomberg and FinTwit and everywhere, including myself. Certainly 2 years ago is not something I focused a heck of a lot of time on. But when you look at historical correlations of these liquidity metrics with financial asset performance, and there's high correlations, behooves you to know whether or not the Fed is adding or subtracting liquidity from financial markets, and use that as a ballast for whether or not you want to be long or short risk. And so I think there's a potential here for a $300 to $400 billion liquidity drain over the next 3 weeks or 3.5 weeks through the end of this quarter. That's a massive amount. It's a massive amount. It's over almost $100 billion a week coming out of the markets, back end loaded. The last 2 weeks of the quarter, up to $150 billion. If you look at the last 8 quarters, the reserve repo facility typically builds on an order of magnitude of $150 to $200 billion because banks are window dressing. Folks are taking down risk. So if the RRP is building up, that means more money needs to come out of reserves in order to fund these treasury bill auctions. Secondarily, interest rates on these auctions are rising. So if Treasury has to compete with the free money at the Fed at 5.05%, all of these auctions are getting done at 5.2, 5.25, 5.3, 5.4%. So we're raising the global cost of borrowing for the US government, which then has kind of knock-on and follow-on impacts towards any other US dollar borrower in the world, whether it be an emerging market borrower, an overseas borrower, a small cap borrower, a cyclical borrower. Cost of capital continues to go up. So those are the dynamics in play. Clearly for now, the biggest driver has been daily options, AI, tech outperformance. And so that's been, and also there's been a sizable amount of VIX call selling because there's a lot of VIX call buying into the debt ceiling issues. So I think that's kind of largely now past us, certainly after today, given what the VIX has done. So look, the VIX is down at, 13 handle. Markets are basically, many markets and many stocks are close to the highs for the year. You have a very sizable amount of potential liquidity being drained. You have, still an unknown about the June Fed hike meeting. I think if there's a strong CPI print, there's a reasonable likelihood that the Fed will actually raise rates this month and take up the dots for 2024, which we can get into. So to me, that's a concerning sign. And I think there is a, shorter term worry here, for risk as we kind of head into the end of the quarter.
What about the JP Morgan collar? We got 43.20.
Yeah. So 43.20 is less than 1% away. So we've seen that top strike act as a magnet, but also act as a ceiling, various quarters over the course of the last, year plus. And so, as we approach that figure, dealers are going to be very well incentivized to make sure we don't kind of materially, move above that. And as we get closer to the end of the quarter, that becomes a bigger deal. So I'm just not sure what's going to drive us materially above that strike. You're not going to get it from a surprise out of the Fed, because right now we're only pricing in basically a 20 to 25% chance of a hike in June. So I don't really think them not hiking is that much of a positive surprise. It's unlikely that you're going to get a Fed that is dovish. You may actually get a one, if not two, hawkish descents to a pause or to a skip, which would suggest that July is still a live meeting. I don't really see how you're going to get an earnings reacceleration story imminently. You don't appear to have a global growth inflection positively here out of China or out of Europe. And so what do people think is going to be the positive catalyst from here to drive us materially above this 43.20 level with, the VIX already sub 14? I struggle with it. I'm curious what, how you think about it. But for me, I think we've arrived at this destination, and now we have to deal with the next phase, which is the liquidity adds, which liquidity drains, which I expect to happen as everyone is basically, max long again.
Okay, well, I have some thoughts on this, and I apologize. I don't know why the camera keeps dying. It might be overheated. It goes up, I crawl under the desk when you're not looking, I wiggle a few cords, I come back up, it's working again, and then it stops working. So I'm not going to crawl under the desk anymore while we're talking. So this is basically it in a nutshell for me. I know I retweeted this actually because it was kind of cheeky. It was tongue in cheek, but not really. We got mortgage rates at 7%, doesn't matter. 500 basis points of Fed rate hikes doesn't matter. We're basically where we were, right? A year ago when we had fallen out of bed, and we're now pushing higher, especially Apple all-time highs. None of that seems to matter because we've had all this liquidity and loose monetary policy, and folks kind of have a hard time, I think, tracking that. You do track that, so that's very, very helpful. I do track that. We have ongoing quantitative tightening with this liquidity drain potentially is the problem I see. If they say, you know what, we're going to pause, and we're also going to pause QT, I think we're going to obviously just move very strongly higher. Otherwise, these fundamental and macro headwinds have not prevented this market from grinding higher, as more participants also increase their hedges for fear that we're going to have some big rug pull. And that's actually a market structure that causes the market to grind higher. So PMI hasn't mattered, ISM hasn't mattered, CPI hasn't mattered. Even the pop-up that we had from unemployment rate, 3.4 to 3.7, it was still taken with, just this exuberance that we still have a very tight labor market and jobless claims are still low. Nothing really, retail sales, forget about it. We know the consumer is going to be pinched, especially student payment restart in a month. This has not affected yet a big deal in credit spreads. We've had the yield curve inverted for over a year. We've had exceedingly exuberant mega cap tech valuation, S&P earnings declining, nothing. One of your favorite tells, leading economic indicators, is absolutely a recession tell, and nothing yet has triggered. And I don't want to say tongue in cheek, but the hedges that are being created really do have an impact on the market making and the flows, this market structure that is really kind of left for this very, very dark area of the market to understand, but those are the folks with power. So recently, in other words, I'm talking about the large positioning that basically creates these hedges and in large part kind of forces these market makers to buy the underlying, which lifts the market a little bit and then a lot. So what I'm getting at is we're not there yet. I also, as you know, kind of study this intermarket very, very strongly. And yes, I can see a sector rotation stalking that value rotation once growth peters out, which is now, and starts to pull back a little bit, but it still hasn't even triggered, which implies that we're still going to push higher. In other words, we've already hit that weekly gap fill in SPX, which specifically from August, we gapped down August 2022 and only recently filled that weekly gap. So for technicians, it's really powerful. We filled the weekly gap. It happened to be 4218.70. We're now above that, right? So we've hit the 4,300, that nice psychological level by a few pennies. And the same thing with Apple at 185 by a few pennies. And we're still sideways. So this grind higher into 4,400 is absolutely believable. We just don't have the trigger, a macro trigger to create a volatility surge even though the selling of volatility right now is much more risk than the reward. If anything, we should revert right here, right now, very, very soon for this test of complacency. And then after we have a little volatility, because we are in a 13 handle, then the most likely scenario is that we continue to grind up to that 4,400. So I am still basically bullish. But with every trade, I expect to be wrong. I am definitely looking at the flow of the market structure. And in particular, it fascinates me because I had a post where a tweet, and for clients, I said, hey, guess what? Goldman Sachs actually sees a risk where we're going to have gamma flipping negative above 43.90, right, which is right up to that kind of like 4,400 area. Well, that's new. You don't usually have a negative flip above a price level. It's usually lower. Anyway, these investors right now who are late to the game, last in, first out is ultimately what it's going to be. But these investors are panic buying out of the money call options. They're above the price. They want to benefit from this squeeze. Maybe they missed it from, the bank bailout in mid-March, and they've seen this take off without them. So they continue to buy out of the money call options for this squeeze. It's completely altered the gamma profile. And now instead of the, we are still in positive gamma, but instead of negative gamma actually being negative, it's a positive. It's the first time that's happened. It's very, very rare. And I'm probably not explaining it very sufficiently, but if the S&P goes, if SPX goes up 4%, instead of becoming longer, dealers start to become short the market, which is negative delta. And this is where I think we're going to get our blow off top and then fake breakout, fast failure, and down hard. That's basically what I'm looking for to happen. And we haven't gotten there yet, but we're getting a lot closer, like 100 points away, kind of closer. Any thoughts on that?
Yeah, look, I mean, I think you're, when I listen to, how you describe it, I would say there are, a variety of different factors that folks look at and markets look at, whether they're fundamental, technical, momentum, flows, cross asset, a variety of different indicators. And what I would say is that for me, most of them kind of are setting up, not great. But the one that is the most constructive is kind of the story that you laid out here, which is a market that just literally doesn't care about anything fundamental. And so I don't know, like after doing this for a long time, when I typically hear those types of things, obviously, it's frustrating, but it doesn't behoove me to, chase that FOMO, narrative here. And if we're talking about a situation where folks are justifying the continued move higher in U.S. equities broadly, based on kind of what sounds like what sounds almost like Ponzi in a way, which is it's going up because it's going up. I want to sell it to the before I can get out. I look and say, well, how does that fit into where we are now with respect to what is Vol saying, and how does liquidity look? And so I just think it's very difficult to embrace a structural shift from growth to value while the Fed is tightening and Treasury is selling a lot of securities and liquidity is being drained. If you told me liquidity was going to continue to be added, sure, but we're going to have a very, very sizable liquidity drain here with the VIX at 13. To me, it just seems like this is all very much priced in. And so we are now at risk of a short-term pullback here because, we're justifying it going up because it's going up. And so that to me is a worrying thing. I think if we had a correction between now and the end of the quarter, we could see July kind of start off well, and folks can get excited again about whether or not the Fed's going to raise or not, and the soft landing narrative, and that could push us higher into July and early part of August. But I just think from where we are now, we've arrived. I mean, we're here. We're at this top strike. We're above 4,300. The VIX is 13. Like, I don't know. I mean, I feel like you're playing for the last little bit of outperformance here. And there's a extraordinary amount of potential downside. And what I would also say is that outside of the U.S. equity market, you are starting to see some of these divergences. And I think you're picking it up the most in currency markets. The dollar is really starting to strengthen, I think, in a fairly significant way over the course of the last several weeks here. Really is starting to outperform all DM currencies, and even emerging market currencies, which we've talked about, dollar, CNH, and the like. So, I see that dollar up. I see yields remaining high, particularly in the front. So we could just be in the situation where the U.S. assets continue to attract capital, and that leads to this last blow off in U.S. stocks. But there's other places where some of this liquidity contraction could show up more, whether it's in emerging markets, whether it's in Europe. And so, I'm not here sitting and saying it's time to, get max short S&Ps or NASDAQ, but I am cautious here when I see this amount of liquidity that potentially could be drained. I just, it's just not for me. I'm not going to be chasing.
And that's wise and reasonable and rational. My only point was it's not necessarily the market structure, because it's clearly FOMO calls, out of the money calls, and then lots and lots of hedges by selling calls up above.
And look, this is important now, right? This is something that I think we all need to do more work on and learn more about and figure more out. This is a very big flow, particularly when there's no news, no Fed, no nothing. It is the most important factor on a day-to-day basis.
Correct.
How are we set up? How is the market setting up for tomorrow's, daily expiry, right? Today, there's only daily expiry in NASDAQ and SPYs and Qs. Tomorrow, they add IWMs. And then Friday, it's every stock has a daily expiry. So that this is obviously very important. But I think, stepping back and trying to think about more from a swing perspective, where are we going? Would I rather be selling into this or trying to chase it? I'd rather be selling into it.
Okay, well, this is just what I wanted to kind of, a few charts that I popped up while you were talking. First, this is the dollar, a little bit bigger picture, not my weekly one, but it kind of shows that we definitely have some oversold levels in the dollar that are getting supported on some key, trend lines. But this is stuff that we do every single day in the trading room. And this is basically that 101 level, the COVID, freak out. And it's pushed basically back into a key level, but it's definitely not rip-roaring bullish in any way, shape, or form. We have that central bank intervention back in October, and that absolutely put a complete kibosh on the 10-year rally, the US dollar rally, and it has come down forcefully since, and equities have gone up forcefully since. And that's all that, liquidity that we talked about that Matt King summed up at $1.5 trillion. But the point is, it's having a bounce, but it is not at risk, in my opinion, until it can get back in play kind of above that 106. Then all bets are off. Otherwise, we could just as easily fail and head down to 98. And I got to tell you, that's still my baseline bet. This is just the dollar a little bit tighter. This is a weekly and this is the daily. And excuse me, but just kind of show you, that's the 101. Here's a trend line, right? And the market has not really cared. The dollar has been digesting, gold has been digesting, the dollar yen, the dollar yuan have been marching higher. And the market still is unaffected as it relates to the macro risk, in large part because yields are not spiking higher. This happens to be T-bond futures, ZB, but you can do this with any. You can absolutely, TLT, for example. But we had a lot of distribution here, and it broke down, and literally bond bulls defended perfectly on this trend line, but that has been pierced. That has absolutely a risk of breaking lower. And if bonds breaking lower, yields higher, that supports your view. Dollar higher, I can definitely see a case for a little motion higher in the dollar for sure. This 105 up to 105.66, but it's not risk off big picture for equities, in my humble opinion, until we can really push above that 106. or really push above 3.9 on the 10-year. So those two things still haven't happened. And while those things have not happened, the market continues to grind higher. So, you know,
Sam, I think your charts are not loading properly here. You're stuck on a NASDAQ chart.
Really?
Yeah, it was. So maybe it's just try to throw another chart up and see if it works. Let's see here. Right. Yeah, there you go. Now I see the dollar.
What the heck was it showing? I'm
It
having
was showing your a NASDAQ.
NASDAQ? Okay, well,
yeah.
I don't know, but this is
Now
what
it shows.
I'm showing.
Now it
it's
shows
showing
dollar.
All right, so that was
Yeah.
basically, you didn't see the big picture one either?
Nope. There you go.
Okay.
No, we didn't see that one. Now we do.
Whatever. All right, that's the big picture one. And then I was basically just showing the up close one. And then I was showing bonds, and I have no idea what the heck I was showing. Anyway, the point, or why my camera isn't working, and I'm really peeved about both. But long story short, that's really helping underlying, you know, macro headwinds are at bay. Man, they're just not able to go too far. And this is that this is that growth rotation rally. And I show this all the time for clients too, which is why I'm getting excited about a value rotation. And luckily talked about this in detail last Thursday morning. And then of course we had a big pop-up Thursday, a big move on Friday. It was in fact the largest outperformance of small caps over large tech in 2 years. So this is one of the charts that I use to kind of time it. And I'm waiting for this to come down, which basically means growth peters out. But I also know that this can just as easily pop right back up to this trend line. And I have to tell you, I'm swagging it, but that's probably about 4,400. So it has not confirmed a rollover, that growth to value rotation. And I definitely am looking for it. Even if Bitcoin, you know, that was easy, 25,000. We break that, we head down to 23. This is a liquidity tell, but it's so not interesting anymore. It's not as tightly correlated with growth. And growth right now is still in play. Markets are still grinding higher on some very large hedges, and everything, even oil as a macro headwind with OPEC coming in and, you know, threatening cuts. They did, and it was a nothing burger as expected. They're losing some of their pricing power. So there's so much, although some say this is a sign of weak demand. That's not necessarily my baseline bet. I'm just not seeing the macro headwind in any of the things that really matter. So it kind of goes back to, and I don't have my picture, but anyway, it goes back to this market structure. They are still buying this AI dream and this tech rotation with companies that are very large and not going out of business with lots of cash. And they're FOMOing it, and they're buying lots of hedges for the macro funds that aren't necessarily so keen, because the fundamentals do show signs of recession getting pulled forward if employment continues to move higher. It has not moved lower. So the next print will be very important. Yeah, I think the FOMC decision in a nutshell has, I already, you know, I believe firmly that they're going to pause. And I've been saying that since the bank bailout. They did enough.
Yeah.
So that was going to be May. It was done and then pause. So I'm still on that bandwagon, and I haven't moved for 3 months. So nothing has changed. I really think they're going to pause. Come June, they're going to announce it. If anything, we get a potential, you know, by the rumor of a Fed pause/pivot, sell the news of one. So the question I have, and the only question I have, is at what price target will we be before the FOMC meeting on the 15th?
Right. Yeah, I just threw up the chart. I don't know if you could see my chart here, but
Yeah.
this is, you know, I think part of my concern is this is net liquidity versus S&P, right? And so clearly the orange line here is the S&P kind of, you know, busting out to, you know, nearly the highs we saw back in August, and it's increasingly disconnecting from the liquidity indicator. You can see how this is liquidity at the end of the year, and this is liquidity right into the SVB issue.
Yep.
So we've seen how liquidity has been added, right? And what I noticed is that clearly there's a fairly tight correlation here. So this is, you know, I think undoubted. When you have situations where, like in the middle of August and the middle of early part of February, where you have this disconnect between where the S&P is and where the liquidity indicator is and is going into an important event. So like back here, this was into Powell's Jackson Hole speech. Obviously, we had a market that was on fire as liquidity was being drained. He comes out, he's super hawkish, right? This is in February. The January Fed meeting, kind of a similar situation. He comes out hawkish, and then the employment numbers come in, and people are like, "Oh crap, there is no recession," and the market's correct. So here we are again into a situation where the market has completely disconnected from the liquidity indicator. Now, the question from here is, well, where is the liquidity indicator going? So I would contend this liquidity indicator is likely to fall down below 6 trillion by the end of the quarter, and maybe down towards 5.9 trillion, which would be a $200 to $300 billion drain. So if we're talking about a liquidity indicator down here at 5.9 trillion, right? That means the S&P at 4,300 is 500 handles above where I would expect the June end of quarter liquidity to be. Now, that's fairly sizable. And that's incredibly concerning. And so now some people would argue and say, well, you're wrong on your liquidity expectations. And I've already pushed back on that. I think that we're going to get more bank reserve drain than we are going to get money out of the RRP because of where yields are. And because there's also this dynamic in play at quarter end. You could see at quarter end, right here, quarter end. Let's just go back to 2021, quarter end. Liquidity drain, quarter end, liquidity drain, quarter end, liquidity drain. Again, boom, March, boom, June, boom, September. It's every quarter end because the RRP grows on average $150 to $200 billion. And it's been as high as $400 billion. So here's the RRP into the end of the quarter over the last 2 years. I'll show you this. So here, we'll just go back to
gorgeous topping pattern.
What's that?
That's a gorgeous topping.
Yeah, potentially. It might be. So here's September of 21. Boom, 500 billion. December, boom, March, boom, June. Every quarter end we get liquidity drain on the order of magnitude of 150 to $200 billion. Okay, this is going to happen again this quarter. So what I'm saying is my indicator here of liquidity is likely to fall by a sizable amount into the end of the quarter here. And it's going to be exacerbated. That would be in a normal situation. It's going to be exacerbated because of how much Treasury is going to be selling in the next 3 to 4 weeks as they look to restock the TGA. Now you could say, well, Yellen's lying. She doesn't care. She just cares about the stock market. She announces the T-bill auctions every other day. We see the numbers. We know how much she's issuing. So she's not lying. Today she increased the 4-week by 25 billion and the 8-week by 15 billion. And then next week she'll increase both of them again by 10 to 15 billion. So every week that goes by, every week that goes by, we do a 4-week, an 8-week, a 17-week, a 3-month, a 6-month T-bill. So we're raising, gross 200 or so billion dollars a week of T-bills. Now, a lot of that goes to pay off old T-bills, but the net increases are going to ramp up now for the next 3 to 4 weeks. We also have this $125 billion of duration selling, which starts next week, and then it's the last week of the quarter. We also have QT. We also have the tax payment. So I'm saying that this liquidity indicator here, which ended today at 6.18 trillion, is going back down below 6 trillion by the end of the quarter. And, a $300 or so billion liquidity drain is a lot of money in a 3-week period. And that comes at the same time where we disconnected massively from this indicator with the VIX already at 13, with folks buying. Here's a chart. I'm sure you've seen this, but this is the chart of, I don't know. Can you see this thing here? This is a Marketeer had a good chart about downside protection. Basically, it's kind of been a bit eviscerated. there's another chart of that Friday was the biggest day of call buying that we've seen ever, right? Folks are folks are getting long, and rightfully so. I'm not going to sit here and say that hasn't been the right call, but I don't know. A lot of this feels like we've arrived. People are getting euphoric. The VIX is euphoric, and if I trust the process of how important liquidity is to the underlying markets, I have to be cautious, here as we approach a Fed meeting next week and into quarter end. And so, yeah,
and
look,
no
I think
argument, no argument. I'm simply looking at the hedge, the market structure, the hedging that still is pulling us up into that 4390, 4400 area. So my point is, yes, I expected this gap fill 4218.70 with an overshoot to 4300. We're there. I'm now looking for that rollover, and I don't see it, except for the cautionary tail that we do have this VIX obviously on a 13 handle. So it's due for a nice reversion pop. But my point is, it doesn't mean that it's done getting suppressed. So no, I definitely see the same kind of chart setup. In fact, let me just, now that I hopefully, and let me know if this really does work. Okay, this intermarket that I was kind of showing you, or tried to before when it wasn't loading. Okay, tell me if you can see this chart. Yes, you can.
Yep.
All right, so I've shown this before, so I'll show it again because it's, it's got some interest. And I get asked for it because I also see this as kind of a tool. This happens to be NASDAQ to SPX on a monthly. It's an intermarket tell. And just to kind of catch anyone up who doesn't know, I used this back in 2021 along with my net selling indicator, that a lot of stuff under the surface was coming back down. We knew that from February 21, and then it continued. And then October, November, we had some very strong selling come in. And basically this, I just wrote a question mark next to this going, it looks like a head and shoulder, which means NASDAQ to SPX, 13-year outperformance in NASDAQ. I made the call in January of 2022 that SPY would fall 20%. This would pull back, NASDAQ would be done with its 13-year outperformance. And that actually worked. This was one of the key reasons I do intermarket analysis. Now, we came back down here into October. That was that central bank, coordinated intervention. We're talking Bank of Japan, China, Swiss National Bank, US, Fed, Treasury. They were all in cahoots. And now this channel trend line, which basically represents the outperformance of NASDAQ, right? And we all know about the concentration risk that has really occurred with the mega cap tech plays. But recently, in the past month, we've had junior tech come up off the ground because we have been chasing that, and it's been phenomenal for the past 5 weeks. So the junior tech stuff, the oversold, kind of mid-tier cap tech plays. Anyway, the long story short is, this got inside the channel in April. So you can't really tell so perfectly, but trust me, I tracked this. It was April. And it was April when we had this AI exuberance, and then we had NVIDIA. And this is what shot it in here. So I don't know if this is going to time. And by the way, this was, shared a week ago, 531 with clients. But the point is, I am looking for this tag and then a pause. And I don't know if that's going to be the 4390 right number, but it definitely is getting closer and closer. And then, this semi one, because we have to watch semis. There's such a strong cyclical and tech play in this world of higher market returns of late. We can see where they've really taken off, and that underperformance, really underweighted asset of semis got a huge bid. This is October, by the way, but this is, NVIDIA. I haven't checked. This is obviously from a week ago, but the point is, this is also kind of forming this topping. But I hear you. I did the same thing, right? For clients recently, which is tech is definitely overbought. And the last in will be the first out. This is that, SPY versus bank reserves. And we're watching this one like a hawk. I actually like to follow the 10-year. It works inversely as a tell on bank reserves. So right now, SPY and bank reserves are, pretty tightly correlated, but then the 10-year is inversely correlated to bank reserves. Big picture, like your chart that you just showed, which was pure liquidity. This is actually flows, cumulative equity flows. And you can see that they have been topping out for all of 2022 and 2023. We're halfway through it. We are still really just plateauing. I know if bulls are really, really bullish, man, they better come up off the sidelines and make this move higher. But otherwise, this just looks like it's exhausted. So anyway, long story short, I agree with you. We have the same sentiment, which is we are pushing our luck up here. But we have not had yet, anyway, a solid bout of volatility. And I do not think we are going to go right from, and I did, let me just kind of show this as well. Hold on. My baseline bet also the same time, I was sharing this with, this is where I kind of dump this stuff. Anyway, so this weak breadth versus sector rotation, right? Same idea, same time frame, which was basically, if you can see this, is in orange, okay, is SPY, is SPY. And this particular ratio is RSP to SPY. So you're kind of showing that the anti-momentum plays, let's put it that way. This is anti-momentum, think banks, reflation trades, all that stuff. It was exceedingly oversold, which was why I was stalking a value rotation that I think will really pick up after we get through June. But I don't think we're going to go right from growth into value. I think we're going to go from growth to volatility and then into value. So, you know, this is getting into a place where I think this rotation that we have also seen the past few days, and I really have been stalking this value rotation strongly in every perspective I possibly can, from option to dark pool to intermarket, the whole thing. I can see that they're positioning for it. They're absolutely positioning for value. So the question is when, but they want to be ready. So they know that this is not going to last. This momentum thrust that we have, if it is 1999, then June will be choppy. Then we will start to follow that 1999 after the 4,400. So the 4,400 to me is a melt up trigger. And I have a hard time believing we're going to have it happen when we have the backdrop of your TGA, you know, analysis of liquidity coming out with QT still happening in the background. So I'm still looking at that, you know, that level of 4,400 to be the timing of the FOMC. We're going to pause, or quarter end, you know, that rolling of the JP Morgan collar. I just don't have it precise, but I think it's going to be June, and then we're going to have volatility, and then we're going to have the value rotation pretty much through September. That's my baseline bet.
Yeah. Look, I think there's an outsized risk now because of the liquidity drain in June. Then once we get to June 30th, there is time, we reintroduce time into this analysis, right? Then because the duration selling is a little bit more back end loaded for the third quarter. It's more like an end of August, September event as far as when Treasury is going to be selling their, you know, long duration stuff. And then we don't have a Fed meeting until the end of July, right? So I think there's this window now here, which I had been waiting for as a window that opens up once the debt ceiling is resolved. So, and now that we've resolved the debt ceiling, we've reintroduced this narrative of liquidity being drained. And I had thought potentially that Treasury was going to go slow, but the early indications from the T-bill auction increases suggest that they are not going slow. They are just going. And so this is happening now. It's not easy to pre-position for this. And I think the other important thing that people need to keep in mind is that this Treasury restocking is being done with interest rates at 5%, right? 5 to 5.25%, and potentially 5.25% to 5.5%. We're not refilling at 0 or 1 or a very low cost of capital, right? And so Treasury is borrowing at a very high rate. And any company that needs access to capital imminently, and maybe there aren't that many, but there are some. And as we push through the rest of the year, more companies, more individuals need more money. That's all going to be getting done at higher and higher interest rates. And so there is a crowding out effect that is going to be taking place. Now, again, Apple and Nvidia, Microsoft, Google, they don't need money. As a matter of fact, they're long cash. They're investing that cash either in their business, buying back stock, or they're investing it basically in money market funds that are investing it in the RRP, right? So they're earning extraordinary returns on their cash balances now at 4% and 5%. But they're not the rule. They're the exception, right? There is plenty of companies that run with leverage that have net debt to cash flow, net debt to EBITDA ratios that are elevated, that are going to need capital. They're often smaller companies, they're often cyclical companies, et cetera. And so they're going to be borrowing over the course of the next 6 months of this year at higher and higher rates. Historically, that's not been good for multiples. That's not been good for earnings for those companies. So I think that we could continue this bifurcated market where tech does well, big cap tech continues to do well, and everything else doesn't. But that's the story, I think, for the rest of the year. But here and now, that the debt ceiling has been resolved, we have this dynamic in play. Higher and higher treasury issuance at higher and higher cost kind of crowds everything out. And that is happening into a Fed meeting with the VIX at the lows. And one thing I've said about the Fed is that I think the Fed remains in the vol dampening business, and they are in the vol dampening business really from both perspectives, right? So when vol, and I think this is something that folks forget, when vol gets elevated, the Fed comes in to do something to talk vol down, right? They, intonate maybe they're not going to raise as much, or they're going to add liquidity, whatever it is. We've seen this time and time again. The VIX above 25, above 30, some magic happens and they're able to bring vol down. But similarly, when vol gets too low, the Fed has also acted against that. Jen Carson, I think he refers to it as, I forget, the Fed is selling calls. Yeah. And you have to think about it from both perspectives. As the vol is too low, since the Fed hasn't achieved their objective yet with respect to inflation, they want to continue to buy time in order to get closer to that point where they can kind of declare inflation solved. And they know that they run the risk that if they're too dovish and they allow markets to levitate and continue moving higher, that they could potentially re-spark animal spirits and inflation expectations, and that starts to move higher again. And then oil moves higher, the dollar weakens, and then we're in this feedback loop where headline inflation moves up, and then they're going to be hiking again later. And that's not something that they want to get into either. So,
but it's a tomorrow problem, meaning Q3.
Well, I guess, but
Q4,
right, for sure. But we're into a Fed meeting with the VIX at 13, and that's not been a good time to over the course of the last 18 months to say time to fight the Fed. So I think we're setting up for something next week from Powell that smells hawkish, more hawkish than what's being priced. There's a potential for the June hike. Right now, we're in the 20-25% camp. I think if the CPI came in very hot, not expected, but if it did, we would immediately move those rate hike odds up to 75, and they would probably go. If that number is in line, there's a skip, but there's two descents, and the 2024 dots have moved up materially. Right now, market's pricing in 8 cuts between now and the end of 2024. I think, and the Fed itself is pricing in 4 cuts in its dot plot. I think they're going to move those 2024 dots up materially next week to try to force the market out of this belief that they're going to be imminently cutting rates, because there is a defeatism they're working against their own interests by having an expectation for rate cuts next year. Because if economic actors believe that the Fed is going to be cutting rates next year, or that it's just going to be a soft landing or a very minor recession, no one's going to lay anybody off, right? We're not going to see the job losses that are necessary in order to break the back of inflation. And so part of the problem is that companies have spent years trying to fill up their labor rosters, and they don't want to lose people that if we're just going to have a small recession or if the Fed's going to be cutting rates. So the Fed needs to remind economic participants that they're serious about keeping rates at terminal for a long period of time. And I suspect we're going to hear more of that next week, and a Fed that tries to price out these cuts for next year. So that to me is a concern amidst, a growing liquidity contraction scenario.
Excellent. Now, what about, and I shared this screen because I shared it with clients, but I want to get your take on this, right? So I shared this in the live trading room yesterday or today. Value typically performs better when rates get less negative. And you can kind of see in 2020, the bottom of, and then again in 2021, we had this really nice energy outperformance for 2022, but now we're kind of back down into this way oversold area as literally rates get less negative. So value, I'm asking a few questions are related to the value rotation, and then there are others that are related to gold. I thought, why don't we kill two birds with one stone, talk a little bit about real rates growing less negative. I want to get your take on that. But look, on this particular chart, just to kind of highlight, we're literally at the zero mark, right? So value typically works better when real rates are positive or at least growing less negative. We've got big outperformance that we've seen in the past where this that's followed through. We've obviously been swamped with mega cap tech concentration risk and outperformance with the AI rally, but now the junior tech is starting to come up off the bottom. So that's actually been a durable, at least swing time frame. I don't know if I trust it beyond that. But kind of getting back to this, real rates, what's your view on where we go moving forward? I personally can see very much from all the evidence that I've kind of shown that we can have an outperformance on a relative basis for value, but I also think we're going to get a little volatility rug pull first. In other words, value will fall less. So what's your trajectory, long story short, for real rates continuing? Because this will segue into a gold discussion.
Yeah, look, I think we're going to continue to see real rates moving higher as the Fed intonates being on hold for longer, even as inflation is likely to fall. So rates up, inflation down means real rates up. Now, as far as this chart is concerned and this shift of value from growth to value, I need to think about it more. I mean, there is definitely, and at the risk of saying this time is different, but there is definitely a dynamic in play here where you have these significant US government fiscal deficits that continue to grow, and you have the government that is borrowing at higher and higher rates itself and crowding out other economic actors and companies that are cash poor. And so to the extent that we have an increase in borrowing costs for cyclical and value areas of the economy, and banks are also typically within value. And I think what we've seen, here is that as rates have risen, banks are having more trouble, right? Because they're having more of a, there's a point in time where real rates moving up is good for value, but then we get to a point where it's actually not good anymore. I think that we're noticing that for various sectors and companies, particularly these regional banks that have to now have a business case, right? There's a business issue if they cannot compete with the government for capital, if they're losing deposits because they cannot afford to give deposit rates that compete with money market funds and that can compete with the RRP. And so their cost of funds is moving higher, clearly an earnings and valuation headwind for banks. Similarly, for levered parts of the economy, if we're not getting cyclical growth reacceleration, energy companies, material companies, commodity prices are not moving higher, then these companies don't have earnings power. They don't have pricing power. And so they don't have earnings growth. And so they don't have, the potential for equity outperformance. I think if you look at the big cap growth stocks, though, they are cash rich. They are benefiting as rates go up now from an earnings perspective because they, their cash is earning higher and higher rates of return, and their multiples are not, they are getting an earnings bump to offset the multiple hit that comes from higher real rates and higher rates. Now, it's, again, at some point, the higher and higher rates are going to break the consumer, and they're going to break the economy, and no one's going to buy an iPhone, and no one's going to do any online search at Google, and everyone's going to stop shopping at Amazon. But with wages and the labor market still robust, that we're just not there yet. And so that's what makes me reluctant to get on this growth to value rotation for anything more than an oversold bounce. If you throw back that chart you had up on growth to value and how we're at that potential pause spot here, where a bounce. If you go back into the 2019 and through COVID and 20, that ratio made even more projected lows, and we just kind of kept going. And I think it's more likely that is the scenario that we find ourselves in moving through the back half of this year than we are to see a sustained outperformance from value in this economy, because I do still think the Fed is trying to break the back of inflation. I do think they are comfortable with creating recessionary type scenario that brings the labor market into weakness, that takes the unemployment rate up 80 to 100 basis points from here and causes that kind of recession that snuffs out wage growth and thus core inflation. So I'm still in that camp. I think it'd be a mistake for them to pause, from them to skip and then hike. I think they should just go ahead and hike now in June, because I think the market's not going to necessarily believe wholeheartedly that a skip means a pause later. But we'll see. We'll see what happens on that front next week.
How about gold?
Gold, I think gold has way outperformed from a real rate perspective. Typically, when real rates move higher, that's a significant headwind for gold. And so the fact that gold has held in relatively well despite moves in real rates suggests that something different is happening with respect to how investors are seeing gold. And what I think is happening, I know this is a little bit 30,000 foot and a little bit the stuff of conspiracy, but to me, the growing deficits of the U.S. government are being noticed by global markets, and this debt ceiling nonsense and default risks are waking people up to how big the U.S. deficits are, how bad we are from a debt to GDP perspective, how bad we are from a tax receipts perspective. I mean, we are currently in a situation where interest expense is growing, entitlement spending is growing, and together the two of them are north of 100% of tax receipts. So, historically, that means we are basically, almost in kind of Ponzi land. I mean, we are borrowing now to pay back interest on the borrowings. And so I think the gold market is starting to sniff that out. I think globally, more and more of our enemy countries and maybe some allies as well are starting to transact away from dollars in commodity purchases, and an alternative system is gathering momentum. It's not a story for today or tomorrow, but it is happening. And I think gold is at the center of that as a neutral reserve asset. So I think that's what we're seeing. And so to the extent that gold has been hanging in here and can hold on as the dollar rallies, I think is a real tell. And eventually, when liquidity in the US gets tight enough and it becomes a real problem for our economy, and the Fed is forced to, or it becomes a problem for the government's ability to borrow at reasonable rates, and the Fed is forced to cut rates or NQT or what have you, that will be the kind of last ditch for the dollar, and gold will really have its day. I don't think it's today, but I think it's happening at a more rapid pace than folks realize.
Okay, so that's the big picture view on gold. On the smaller time frame, I have been recommending for the past few weeks, which I think has turned into, I think more than that, a pullback in gold, silver, and precious metals, and it's not done. It needs to base before I get constructive on long gold again for swing long. As a trend, it already triggered in, oh gosh, November, December. You were so early in saying, oh, this is it. And you were absolutely right. And it took me a few months before it actually confirmed. And that's not like in a live trading room when I'm doing chases and swings, I can spot all kinds of rotation underneath. But gold is tougher for me to really see accumulation because there's so much false data out there. But as it related to my intermarket triggering as a trend long, it confirmed in December, January. And it's obviously pulled back since the last FOMC, but not very much. So it has been inversely trading with the dollar yen. And that's one of the reasons why I think it has pulled back as the dollar yen has moved higher. And basically, I think there will be a big dump of gold and precious metals if the dollar yen gets above 140.80. That is my baseline bet. So I'm sticking with it. Otherwise, it's just been digesting along with yields, along with dollar. None of the three are really fashioning a risk off posture. So we need a little volatility to reprice equities. And if a value is going to get a follow through, I know you're suspect on the whole thing, but I like my rotation forecasting so far. It is still very productive, but it is absolutely, as you said, a shorter term kind of bounce, right? So I still see reflation trades like the energy, oil and gas plays, right? That was a fabulous short. I don't think they're done. So it's very hard for me to get excited about a solid rotation in June. Absolutely not intervalue. But I keep looking for it and thinking we will have more evidence in July. Are there any questions in chat that we didn't cover because we're over our hour?
Looking here. Someone asked about student loan payments restarting. I mean, I think that is, another. Yeah, that's a headwind for a consumer. I think that's, that'll help kind of stock the TGA also. So that'll come out of reserves. But I've seen the economic impact is not, overly material from a GDP perspective. But yeah, clearly that's that's going to be a bit of a headwind. And I think it's kind of, some people are asking about the elections. I think we're too far out to be thinking about 2024 at this point. So I'm not really too concerned, in either direction there. I think there's a lot of things that could happen between now and let's say nine months from now when the election starts to becoming more top of mind.
Got it. All right. And then as far as assumptions, Dimitri, about if they're wrong, in other words, if the index continues climbing higher into year end. So I'm not against that premise. I know it's a working thesis for many, right? They're extremely bullish because the economy is still withstanding a lot of these rate hikes. And bad things haven't happened, and liquidity is still in the market, and loose monetary policy is still very supportive, right? They come in at the whiff of crisis, and that's basically climbing that wall of worry that we've had, and the overhead hedges that actually drive this market structure to support the market. So VIX right now is in a dangerously low area for a potential reversal and a shake and bake, which would basically just kind of free up a lot of folks, by the way, who would like to put on more hedges. Right? I say literally, I think the market will get bought because any downdraft of short duration is only going to make it cheaper to put hedges on. So anyway, as it relates to 4,400, yeah, it's only a 2.5% move higher, very doable. And then we'll see, right? I have those, intermarket tells, which basically kind of tell me if I'm like way off. If we get above a particular level, like that channel I showed you earlier, we got inside that and we continue to spike very strongly from April after the bank bailout through May because of AI. And now we've got junior tech kind of picking up. And now we've got the broadening of the rally, meaning value, meaning oversold Russell. But long story short, I'll know it when I see it. Right now, I don't see a reversal. I see what, Craig is warning about, that this is a bit of FOMO that has the strong potential for a rug pull, but more importantly, a liquidity crunch that really forces a negative gamma environment, which would absolutely propel selling. And I don't think we have seen selling. We have not been in a strongly negative gamma market structure for many moons, right? We were in one into the September, October low. And we were about ready to cliff dive if bulls did not defend there. And exactly when that happened, that's when this entire Treasury, Fed, Bank of Japan, everybody came together and put an absolute stop to the equity fall. So they infused literally global markets with liquidity. Now Craig's point is they're taking it out. So we have to be cautious. We cannot be complacent. I agree with that. Okay, so with that, anything else to answer or comment as far as macro event risk? I think you've already mentioned it. FOMC is next week. CPI is before that. The jobless claims on Thursday, something near and dear to my heart. I think we're going to get volatility when we pierce above 267,000 in jobless claims. So we haven't had it yet. But again, even when we do get the volatility, I am not convinced that it will not get bought. So any other final comments before closing? And then we'll do it again on after FOMC, right? Or
yeah.
Okay.
Okay.
Anything else? Nope, we're done.
Yeah, I think I think so. I mean, it's
My
a quiet.
camera will only hold out so long. Apparently, it's got some kind of heat stroke.
No, I think you enjoy the quiet week, and then next week, you know, you gotta get back in the seats, and you know, CPI and the Fed, and you know, the liquidity, and you know, I think the last 3 weeks of June are going to be interesting. So
yeah. All right. Well, guess what? I want to just thank everyone for coming again out for Macro to Micro Power Hour. And I am Samantha LaDuc, founder of laductrading.com with Craig Shapiro, our MacroAdvisor EDGE manager. We have live trading rooms. We've got 3 products. Craig obviously manages the more macro focused one. And I am chasing, swinging, trend trading, anything that comes up in my kind of intermarket analysis and technical assessment, and using macro as a backdrop. But we also have a Discord community, which is fabulous for those who really like momentum, technical analysis focused, and a community of mentors and traders that are purely trading momentum and chase timeframes. So anyway, we've got the 3 products. We invite you to check it out, any of them. Again, thank you so much, Craig, for kind of making heads or tails out of this backdrop of bank reserves and how it will impact market returns. We'll look very much the FOMC statement, and then Powell's presser next week, getting into quarter end, and then what other fireworks we have. We'll come right back in about 2 weeks and do this again.
sounds good. All right,
Thank
take
you,
care,
everyone.
Thank
Cheers,
you.
Bye.
Bye-bye.